All right, folks, joining me now, Oppenheimer Asset Management Chief Market Investment Strategist, John Stoltzfus. John, I mean, you came into the year super bullish. You had 7,100, then you went down to 5,900. Everyone went down in the beginning of the tariff situation. Things are becoming somewhat clear. You know, we just have breaking news that all negotiations have been cut off with Canada. There's a beef over some AI taxes that they want to implement. I doubt they will because their own their own AI companies or tech companies are against it. But still, where are you now?
Still bullish. In fact, we never gave up our bullishness. We just lowered our target because when we came in with that 7,100, we'd put it in on December 9th. And what we were thinking is the market had dropped enough on that first day of the tariff announcement that was so large that we thought we wanted the target we came up with was 17% upside. Right. Curiously, that was looking for 17% upside.
So they both are still 17% upside. I got you. You made the adjustment.
Yep.
I do also want to give you credit because to underscore the fact that you were still bullish, you always had an overweight in the sectors that are killing it. Right? Overweight in information technology, overweight in consumer discretionary, overweight in industrials. And that was the interesting thing. Most folks on the street did not have an overweight on industrials. Why did you focus there so early?
Because industrials was so ignored. And when I got into this business in 1983, 42 years ago, then it was all brass, glass, metal, and stuff like that. Now it's technology, and it's technology that can benefit every one of the 11 sectors, depending upon the insight that management has to adapting to it. Whether it's consumer discretionary, whether it's utilities, whether it's power generation, robotics, and this is what's going to carry us into building the factories that we need to build, improving farmland. What do you call it? It's the yield.
Like that.
It's the yield.
The yield.
It's like a great grandson of an Amish farmer. I should know that.
I didn't know that, by the way. No wonder you're so hardworking. Does anything surprise you? I mean, consumer discretionary, I mean, you're overweight there. Yeah. And we've been, again, so that the consumer's out for the count over and over again.
You know what I think about the consumer? The American consumer, where times are good, will spend like a sailor who's been on a long term of duty who suddenly has shore leave. Right. When times are tough, what the consumer does, they buy private label, they buy used cars, sometimes they buy used clothes, but they keep shopping and they get discount merchandise. But we keep shopping because we justify our existence by what we can buy for our loved ones and for ourselves. That's the American way.
So let me ask you, because purists are worried about valuations here. They were worried about valuations as we came into the year. They're worried about valuations here. This is a fantastic chart. And by the way, your work is always fantastic.
Thank you.
We couldn't use all the charts, but I wanted to share this with the audience because this is something we talk about a lot, folks. Wall Street saying, well, the market's too expensive. The S&P 500 at 21, now it's 23. The average is 20. Consumer discretionary, maybe a little bit below, but most of these are far above their historic average. Mm-hmm. And that makes it hard for a lot of purists to buy this market.
I think, valuation is in the eye of the beholder, and it also depends upon the times. Today, as you mentioned earlier, as we entered this segment of the day's broadcast, what you've got is you've suddenly got the private investor investing like a very astute intermediate to long-term investor. It also happens to be at a time, if you consider, Ed Yardeni says there aren't enough stocks to qualify for the Wilshire 5000 because of all the stocks that were taken out of the public market to become a private equity. There's a huge demand today for the best companies, for the best sector ideas, because investors today know that Social Security, while it'll still exist, will not be the same percentage of income in retirement that it was for their grandparents, their parents, and it's every generation is showing, and when you look at the demographics, they'll still have their gambling stuff and their exciting cocktail party stocks, but they want to invest in those companies that produce better earnings and have good prospects for continually doing that with a good management team and good ideas.
Bottom line, it's always worked and it probably always will. John, great stuff. Really appreciate you, man.
Thank you so much for having me.
Amish farmer, that tells me a lot. No wonder I love you. All right.